Transaction volume in commercial real estate fell off a cliff last year with a 44% reduction in investment sales activity between Q4 of 2022 and Q4 of 2023. The rapid rise in interest rates we saw over the last 3 years has resulted in buyers not being able to get to valuations they could get to back in 2021 and sellers not being willing to let go of properties at significantly lower price points that they could have sold for at the peak. But even though we have seen a huge drop in investment sales activity, there are still deals getting done in today's market. And in this video, I want to highlight what's driving the transactions that we're seeing today and how almost $350 billion of commercial real estate investment volume still made it across the finish line in 2023. So let's start with sellers first, since it's a reasonable question to ask why property owners would take a deal out to the market today given current market conditions. And the first reason goes right back to interest rates, and this is that many properties listed today, specifically multifamily deals, have assumable loans in place with very attractive interest rates. I made a more detailed video on loan assumptions a few weeks ago, and I'll link that in the description below, but these essentially allow investors to take over the existing debt on a property, which can be a huge benefit for buyers today given the current state of the market. With all-in rates coming in at between 5.5% and 6.5% for multifamily loans in early 2024, assuming a loan financed in 2020, 2021, or even early 2022 might mean a 200, 300, or even 400 basis point reduction in the cost of debt for the borrower, which could often allow a seller to command a significantly higher price point. And because of this, in a way, this is allowing property owners to make up for missing selling at the peak just a few years ago, while at the same time avoiding prepayment penalties that would otherwise reduce net sale proceeds and returns to investors. Now, the second type of properties that are being taken out to the market today are distressed deals, with office being the main asset class falling into this category. If you take a look at office listings right now across the US, you'll see a lot of lender-driven sales, short sales, and heavily vacated properties being marketed for sale, with both debt and equity investors looking to limit their liability and get deals off their books. In a lot of ways, it's looking like office might not end up recovering for a while, and with looming debt maturities and the reality of refinancing at significantly lower NOI values and significantly higher interest rates, a lot of office investors are coming to the realization that they just can't continue to kick the can down the road. A lot of these deals are being marketed as repositionings or even conversion plays where the owner could repurpose these into a completely different use, but the reality is that many office landlords are struggling to pay debt service and willing to sell these properties at a loss just to stop the bleeding. And then finally, from a seller's perspective, the third type of deal that's being taken out to the market right now are retail and industrial properties with fresh long-term leases, particularly those with strong credit tenants. With so much volatility in interest rates right now, a lot of buyers are looking to make long-term investments where they can lock in long-term debt with consistent, predictable cash flow being the main priority. And because of that, a single tenant retail or industrial building with a brand new 10 or 15-year lease with a strong credit tenant can be extremely attractive for investors that are looking for stability. And while multifamily revenues can drop really quickly, with most apartment building leases rolling over annually, long-term retail and industrial leases can provide a guaranteed income stream that's backed by corporate credit. Especially if these come with a triple net reimbursement structure where the tenant is responsible for all operating expenses at a property, or an absolute net reimbursement structure where the tenant is also responsible for maintaining the building itself. These deals are extremely attractive for investors right now that want certainty in their cash flows. Now, moving on to the buyer side of the equation, most of what's getting deals across the finish line today is related to how certain buyers are underwriting transactions, starting with cap rate compression rather than cap rate expansion. With the record low interest rates we saw from roughly 2011 all the way up through the beginning of 2022, the standard practice in commercial real estate was to underwrite an exit cap rate or a cap rate at sale that was roughly 50 to 100 basis points higher than the going in cap rate for a 5 to 10 year hold. This was due to the belief that interest rates would ultimately rise and cap rates would increase as a result, but now since we've actually seen this play out over the last 2 years and most of the talk today is around cutting rates, some investors are starting to underwrite exit cap rates that are the same as their going in cap rates or even compressing during their hold period. And because a property's projected sale value has such a big impact on returns and projected returns drive valuations in the market, exit cap rate assumptions can have a material impact on the price that buyers are willing to pay for a piece of commercial property. For example, on a $10 million acquisition of a property that's planned to be held for 3 years with a $600,000 going in NOI and 5% annual NOI growth, if that deal were financed with a 65% LTV loan at a 6% interest rate with full-term interest-only payments, and the deal were assumed to be sold at a slightly higher 6.5% cap rate, this deal would generate a 12.6% IRR. However, if that exit cap rate assumption were to drop from 6.5% down to 5.5%, that IRR would jump up to 26.2% on the deal, ultimately allowing an investor to pay over 15% more for that same property to hit those same returns, all else being equal. And these changes in underwriting are ultimately leading to buyers and sellers getting closer on pricing and narrowing that bid-ask spread that's caused a huge drop in transaction volume over the last 2 years. Now, finally, on the buyer side of the equation, one of the biggest ways that buyers are getting deals to pencil right now is also related to underwriting, and this is assuming outsized rent growth in later years of their hold. Right now, asset classes like multifamily and industrial are seeing huge supply increases that are putting significant downward pressure on rents and occupancy levels in many markets across the country, which is causing investors to underwrite either flat or really minimal rent growth throughout the rest of 2024 and into 2025. However, because of where interest rates are today and the cost of labor and materials, construction starts across all commercial real estate product types are projected to drop substantially starting next year, which has caused the supply pipeline that's expected to be delivered in 2026 and 2027 to look materially different than the deliveries we're seeing today, which is causing some investors to underwrite increases in rents that are well above historical norms once that supply pipeline shuts off. And again, similar to how an exit cap rate can have such a big impact on valuations, rent growth also plays a huge factor in returns, and 4% or 5% rent growth assumptions in 2026 and 2027 can also result in increased pricing, all else being equal. Ultimately, even though transaction activity has slowed down a lot over the last 2 years, there are deals still getting done in today's market, and these are the main things that are getting buyers and sellers closer on pricing and getting deals across the finish line in 2024. And if you want to learn more about the strategies that commercial real estate investors use to value properties like target IRR valuations and how to analyze the effects of changes to assumptions on a projected sale value on a property, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking the CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on the channel on current market events, make sure to hit the like button and let me know in the comments what types of deals you're seeing getting done in today's market environment. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.